What's going on, guys? If you're new to the channel, my name is Nick, and today I'm here to teach you about how to analyze a stock taking a value investing approach. As we all know, there are several different types of investing styles, but I personally like to consider myself a value investor. All that simply means is that I like to buy companies that are cheap or on sale relative to what I think they should be worth. Just from looking at the stock price alone, you really can't tell if a company is going to be cheap or expensive. You really have to dig below the surface of all of the different news articles that are out about the company, as well as all of the hype that surrounds the media. But before we get into the specifics on how to analyze a stock, we really need to understand why it's so important to analyze a stock in the first place. So for those of you that are beginners, you need to understand that a stock simply tracks the market value of a company, and this market value isn't necessarily equal to the intrinsic value of the company or what it's worth. And the share price of a company is not something that fluctuates randomly. In fact, it's highly correlated with the financial performance and the future outlook of a company, as well as the opinions of many investors around the world. Now, since the share price fluctuates based on both the financials of the company as well as the opinions of investors, sometimes we won't be seeing an accurate picture of what the company is worth. Because as we all know, opinions aren't always cold hard facts like financials are. Therefore, if we decide to track the financial indicators of a company, we can theoretically estimate if we're getting a good deal or not by buying the stock at a certain price. Now, on the other hand, if you decide to not analyze the fundamentals of a stock before buying in, you're essentially speculating that you're going to make money, and this involves taking a huge amount of risk. And for this reason, I often like to compare speculators to gamblers. For example, many investors got caught up in the hype of weed stocks here in Canada before it actually became legalized in October of 2018. The stock prices became super inflated and overvalued because of the potential for them to do well whenever legalization occurred, and this was just based on the opinions of investors. Meanwhile, the companies were not even profitable. But as soon as legalization came around and the companies started disappointing on earnings and the fundamentals within their businesses, investors started to realize that it's probably not a great place to put their money, and the stock prices absolutely got destroyed. Now, on the other hand, if you do choose to properly analyze a stock in advance and you do find out that it's relatively cheap, this will both limit your downside as well as increase your upside potential. Sometimes even the best of companies can have their share prices beaten down because of some news in the media or whatever reason. However, usually it'll only fall to a certain level until investors realize that it's actually such a great deal that you can't pass it up. And so that provides you downside protection. Then when the stock price is so low and you've bought in, any good news that happens to the company is going to send that share price skyrocketing, and it'll increase your returns like crazy. And that, in a nutshell, is the essence of value investing: buying amazing companies at cheap prices and then having it skyrocket later on. So in this video, I'll be focusing on some of the most important financial indicators that you'll need to know, along with fundamental analysis techniques to be able to analyze and pick individual stocks. So if you do enjoy the video, be sure to tap that like button for me to support my channel. And if you're new, don't forget to subscribe down below for more weekly content just like this. So with that said, let's jump right into the video. Alright guys, so the first and most popular company value indicator by far is the price to earnings ratio, or the PE ratio. Now, the PE ratio can be calculated by dividing the company's share price by their total annual earnings per share over the past year. So as an example, let's consider Apple stock. So currently, at the time of making this video, their share price is $255 per share, while their earnings per share over the past year have been $11.89. And by dividing these two numbers into each other, we can find that Apple's current PE ratio is 21.4, which is fairly reasonable. Now, to understand this value a little bit more clearly, the PE ratio is essentially the number of years that it would take for the company to pay off its entire value based on its earnings. So in Apple's case, it would take 21.4 years to pay off the entire value of its company based on the earnings that it gets every year. So all you need to know is that the higher the PE ratio, the more expensive the company is trading at, and vice versa. So in general, what I could recommend for a reasonable PE ratio is anything below 25. But if you end up looking all over the internet and you can't find a PE ratio for a company, that's probably because they're not making any money, they're not making any earnings per share, and trust me, you don't want to dabble with companies that lose money. Now, something else that you need to know about PE ratios is that they vary significantly across different industries. Like the technology industry and the banking industry, for example, their PE ratios are nowhere close to each other, and the difference lies in the earnings growth. Generally, if a company has higher earnings growth prospects like technology stocks do, they're generally going to have a higher valuation or a higher PE ratio, and this can actually reach all the way up to 30. Now, on the other hand, if a company grows a lot more slowly, but consistently like bank stocks do, they're going to have a much lower PE ratio, which is typically around 10. So it's important to know that you can't cross-compare PE ratios across different industries. It's best to compare within the same industry. And that brings me into the next concept, which is the price to earnings growth ratio, or the PEG ratio. Now, this measure is simply the PE ratio divided by the expected future earnings growth forecast of a company. You're able to find this ratio along with the PE ratio for many companies on Yahoo Finance, and it typically provides a more complete picture than the PE ratio does. For example, if I found an amazing technology stock like Facebook, which actually has a PE ratio of about 30 right now, I wouldn't necessarily eliminate it until I look at the PEG ratio, which takes into account the earnings growth rate. So typically, companies with a PEG ratio below 1 are considered undervalued. However, you're going to find it very difficult to find many good companies with a PEG ratio below 1, because most are above that threshold. And that's why it's so important to be patient as a value investor, to wait for good deals to happen in the stock market, because even the best of companies have their stock prices drop. Alright guys, so the next financial indicator that I use to analyze stocks is the price to book ratio, or the P2B ratio. And this is probably just as, if not more important than the price to earnings ratio. Now, the PB ratio can be calculated by dividing the stock price into the book value per share, but what exactly is the book value per share of a company? The book value per Investopedia is the net asset value of a company calculated as total assets minus intangible assets and liabilities. For example, if you think about a real estate property, the book value would be the amount that you actually own in the property, so the tangible assets minus the liabilities that you owe on the mortgage. Now, this is a very important ratio for value investors because it tells you what premium the company is trading at relative to what its net tangible assets could be sold for. A price to book ratio above 1 means that the company is trading at a premium above what its net assets could be sold for, whereas the opposite is true for companies that have a price to book ratio below 1, so that means you're actually getting a discount. But typically, I consider a good buy a price to book ratio below 1.5 for most great companies, because you're rarely going to find a great company trading below its net asset value. For example, if we look at Bank of Nova Scotia stock, one of my current holdings, we can find that it's currently trading at a price to book ratio of 1.42, which might indicate that it's at a pretty good deal right now. And if we compare this value to many other banks in the industry, we can find that TD Bank is trading at a price to book ratio of 1.7, and then Royal Bank of Canada is trading at a PB ratio of 2.0. So obviously Bank of Nova Scotia is the cheapest of the bunch. However, it should be noted that this ratio really isn't too useful when you're considering companies without many tangible assets, like technology companies that hold a lot of their value in intangible assets, like intellectual property. So that means that you're going to find these insanely high ratios for these companies, like that for Apple being 12.5, and it doesn't really make sense. Now, obviously, Apple really isn't that overvalued, as we found out from the PE ratio before. It's just that they don't hold many tangible assets. A lot of it's in intangible assets. So that's something important to be aware of when you're using the price to book ratio in your analysis. Alright guys, so now that we've determined some of the most important pricing ratios, it's now time to take a look at one of the most important financial indicators for a company, and that is the return on equity, or the ROE. Now, the return on equity tells the percentage return that the company is able to produce every single year based on the given shareholders' equity within the company. It can be calculated by dividing the total annual net income by the total shareholders' equity, and the shareholders' equity is just the total assets minus the liabilities. Now, the ROE is an extremely important financial indicator for most investors, and that is because it talks about the management efficiency. So how well are they able to deploy their given capital and produce profits from it? Now, just like the other indicators that we spoke about, ROE definitely varies according to the industry. However, you'll definitely only want to be considering companies with an ROE of at least 10%. This is because the S&P 500 has been able to average an ROE of 14% over the long term, so that would be considered about average, and then anything above 20% ROE is absolutely excellent. And just like I said earlier, it's always good to compare the ROE values amongst different peers in the group. So for example, if the average ROE for the technology industry is about 20%, while Apple is able to produce an ROE of about 56%, then obviously Tim Cook is deploying the company's capital a lot better than some other CEOs in the industry. So overall, this is a great financial indicator that helps you determine the effectiveness of the management of a company, as well as its financial health relative to other peers in the industry. All right, now another one of the most important factors when considering a company as an investment is if they pay a dividend. And I know you dividend investors out there have been waiting for this moment. Dividends are a way of distributing profits to the shareholder in the most direct way possible, which is literally done through a cash payment in your investment brokerage account. And these are typically paid on a quarterly basis. Dividends are very important to the investor because they introduce another way to improve your returns. Simply relying on capital gains is fine, but if a recession hits or a company releases poor earnings, then you're likely not going to make any investment returns in the short term. But with dividends, you'll still be able to make some investment returns even though the share price may not be appreciating. And this is why dividends are such a valuable instrument for reducing risk in the stock market. Now, dividends are great, but you will find that those companies that pay dividends, especially for a long time, are going to be trading at a much higher valuation than those companies that don't pay dividends. This becomes even more and more true as the company increases their streak of paying and increasing dividends year over year. In fact, naming conventions were developed for those companies that can keep increasing their dividends year over year. For example, dividend aristocrats have been doing it for 25 consecutive years, and dividend kings have been doing it for 50 consecutive years. For example, let's consider Coca-Cola, a dividend king that's been increasing and paying its dividends for 55 consecutive years. Now, when we consider their valuation, Coca-Cola is going to be much more expensive than another company that doesn't pay a dividend, but has similar earnings growth. And this is because investors are willing to pay more for the stability of the dividend. And sure enough, checking Yahoo Finance, we can find that their PEG ratio is extremely high. So even with slower earnings growth, they're still trading at a premium because of their dividend. So this is just something that you should understand when analyzing a company that pays a dividend. And oftentimes they shouldn't be eliminated just because they're trading at a premium for their dividend. So personally, I like to choose companies that have been paying a dividend for 10 consecutive years or longer, because this indicates financial stability, especially during a recession. Furthermore, it's not only important to look at how much a company pays in terms of their dividend yield, but how much they pay relative to the amount of earnings that they create every single year, and that is known as the payout ratio. So the payout ratio is calculated by dividing the total annual dividend payment by the total annual earnings over the same period. And typically for this, I like a company that has a dividend payout ratio of less than 50% because it means that the dividend is very healthy and it still has room to grow in the future. It also shows that if a company's earnings suddenly decrease by a large amount, like say in a recession, they'll still be able to pay that dividend because they're not paying out all of their earnings. Overall, it's very important for companies to pay dividends and that they've been paying it for over 10 years, which shows strength in the organization. All right, guys, so on top of the points that I already discussed, I want to briefly mention that it's very important to look at a company's balance sheet before you buy it. All of these other financial indicators that I discussed in the video could be totally fine, but if a company's taking on too much debt, it might dig itself into a hole and could go bankrupt. So it's always good to look at the debt to asset ratio of a company and compare it to the industry average along with many of the peers in the industry. On top of this, it's good to know that a company has a lot of cash or liquid short-term investments that they have on their balance sheet. This is because cash is the one redeemer that can get a company out of a bad financial situation if it were to happen, but also it allows them to make acquisitions whenever they need to. So it's good to have a general idea of how much debt the company is taking on, but also how much cash they have on their balance sheet. Overall, these were some of the most basic but important ways to analyze a company and determine if it's overvalued or undervalued relative to the industry that it's within. By no means was this an exhaustive list of financial indicators that you need to be aware of, but it will give you a good head start to analyze companies and start picking stocks. There are actually ways of calculating the specific value of a stock, so do let me know down below if you want me to make a video on that. And with that said, thank you guys so much for watching the video today. I really appreciate it. If you did enjoy or gain value from this video whatsoever, be sure to smash that like button for the YouTube algorithm. Also, if you haven't already, be sure to subscribe down below for more content on personal finance, business, and investing in the near future. And I'll see you guys next time.